Hello, hello. Money Professor Tua Rust here, and people are worried about the stocks and wanting to invest. And I've shown this before, but I haven't done a video, so I want to do a short video on this. This is the Dow Jones. Now, if you look, I don't know if you guys know what the Dow Jones is, but it shows up at the top here. It's about 34,000. It's trading for the last 3 minutes of the day, but on this chart, it shows that the Dow Jones is hovering between 50 and 120. That's because it's the Dow Jones when it started in 1903. And if you'll notice, had you invested money, this is monthly, so this is about 10 years of data. So had you invested in 1903, would you have made money? Right, the answer is no. Had you invested in the beginning, it would still not be worth anything. 20 years later, is the stock market a good investment strategy? No. It's speculation. It's a way to make money. It's not an investment strategy. You need to know when to invest in the market. Now, had you invested in early 20s, then man, you would have made a killing, right? As it shot up 300% in a record like 3 or 4 years. And then of course it crashed. And it crashed because the government and the US just wasn't ready for something like that. So when it crashed hard and fell back below its value. And that's what really hurt people, is when it fell down there. That's what really, really struggled with people. So when it rebounded after a few years, then it was fine. And if you'll notice, this exponential moving average on the bottom shows that the average went from below 100 to, above 100. It basically doubled over the course of those 20 or 30 years. So not a great investment, but okay. So they realized that something was good here. So they took some time to figure out the stock market. And when it shot off again, starting in around 1943, then they put some stop gaps in. So see, when it went up, they stopped it here. It shot up and they stopped it and it fell down a little. And then it shot up again and they tried to stop it here and let it fall down a little. And so they continued to kind of force it down every once in a while, right? Again, stopped it, until it reached a high of 1,000. And so that was great because that went from 100 to 1,000. But it took about 30 years, 20 to 30 years, depending on how you count it. So to go up by 10 times in 20 or 30 years isn't that great, to be honest. It's not a high percentage. It's good, but not wonderful. So then we had the 60s, and that's when we had the wars and everything. And so the market, US wasn't doing well, so it was stagnant. Had you invested in the market, so then you might say, oh, that was back in the 1900s, who cares? Well, what about the 1960s, right? Some of you guys may have had parents or been alive in the 60s. If you invested in 1960s, you would have made $0. In the 60s, we would have $0 in the 70s. Not until 1983 does this thing start shooting up. So again, is the stock market a good strategy? No. For the majority of years, it is not. But if you invest it for 100 years straight, you'll take advantage of these rising meteoric rises. But the majority of time, the stocks are not doing well. They're just kind of stagnant and sitting there. So if you don't believe me, let's look again. So this is it from 1983 all the way up to 2000. Had you invested during that time? Sure. If you were speculative, during that time, sure, you could have made money. And just remember, this isn't one stock. That is the Dow Jones. The Dow Jones is a composite of stocks, and it changes. It used to have Sears, Macy's, all these companies, which are now out of the Dow Jones, used to be part of Dow Jones. So, if you're investing, you can't just buy, a stock and see this kind of a rise. You might have to buy a few different stocks throughout this time as the Dow Jones starts. It's complicated to take advantage of this, but you can take advantage of it. And you can see it was a beautiful rise. It went up 11 times in only about 17 or so years. That's great. That's what made the stock market so famous, was the 80s and 90s. Okay, because then we got it down. But we had done a pretty good job for ourselves even in the 40s and 50s. Okay, but this is when it gets bad. So it should have corrected in 2000, right? It should have corrected for how many years? About 15 years. It does not. See, it corrects for about a couple of years, then tries to shoot off again. And then, this second crash happens, and we're always so scared about this crash, but that was a good, healthy crash. Look, it fell a little bit below the moving average, but, had we recovered around 10,000, that's where we should have stayed, but we didn't. We kept shooting up. And within about a year or two, we had completely erased all of those losses, and basically we had stopped the consolidation. So literally in about 9 years, we stopped our consolidation, whereas in all other histories, we were consolidating for 10 years, right? 10, 20 years consolidation, 10, 20 years consolidation, 10, 20 years consolidation, right? And here we've got, like, you can't even fit on the page. We've got half of my little screen showing for the consolidation here because it's so short and it shoots up. And it's almost like if you didn't count what happened in these 9 years, if you said that this was just a minor consolidation but not an actual retracement down to the exponential moving average, I mean, yes, it hit the exponential moving average, but look how extended we are, then we have been essentially extended from the exponential moving average since 1983. So that's for about 40 years, with the exception of one hiccup, we were extended, right? Even COVID didn't bring us down to the exponential moving average. We should be at 20,000 as a stock market, and we are at 35. So you want to talk about, is this stock market going up or down? Absolutely, it's going down. It should have been falling years ago. And yes, is it going to fall down to 20,000? Probably not, but it could easily fall down to about 30 or 25,000. People will lose 30 or 40% minimum. So if we zoom in a little bit here on the days of the daily of the Dow Jones. By the way, I'm using Thinkorswim. Great tool, trading platform. So don't look at the moving average now because it won't make sense. It won't be helpful. But this is the fall. This is the COVID. And you see it popped up to about 25,000, hit some resistance. That was a good time to buy when it broke through there again. It did fall back down, but it didn't go below. This was another buy signal when it retraced. Then it formed this beautiful channel for a few months in July last year. And then it consolidated. But notice how the consolidation was very wild. It's moving up and down and up and down. And that's telling you that there's a lot of energy. People really want it to move, and one side will win. And when the side wins, it's going to shoot up like crazy. This has a range of about 3,000, from 26,000 all the way up to 30,000, or about 3,000 or 4,000. So you'd expect when it shoots off for the next trend to also move 3,000 or 4,000. So what's 3,000 or 4,000 plus 30,000? Exactly right where we're at right now. 34,000, 35,000. So we are at the end of this little pop up after the initial consolidation, and we are now due for something, right? We're even extended on this exponential moving average, and I mean we can easily fall. So yes, guys, be wary. If the stock shoots above 35,000, then maybe we'll keep going for another year, But look at 35,000 as a point where the stocks might start to fall. If the stocks ever fall below if the Dow Jones ever falls below about 33,000, then look for some major crashes to happen, because people are heavy on the long side. And once we start going short and all the shorters come in, it's going to crash this like in days. Okay, guys. If you guys want to know how to make a ton of money when the stock market crashes, DM me. Hit me up. Money Professor 2.